is there one single metric that you look the most at when you think about is this a good idea or startup or founder?
And we absolutely are excited and investing in the app layer for construction and for real estate. But for us to win in that space, it's going to be about talent and a number of other things, which we can go into as well.
I wanted to ask about defensibility of AI solutions generally. What's your thoughts?
So defensibility can come from a number of different things. One of them could be, which is what we think document crunch's defensibility really comes from.
So do you think that startups right now, when they try to sell to large incumbents or large contractors or companies, is it a long-term sustainable solution?
So I think as a first set of logos and things like that, the ENR top 400 are 100% a great place to start. But in construction, you have to figure out what is for the middle market and the SMB segment.
Hey everyone, and welcome to the Bricks and Bytes podcast. If you're a founder, construction tech enthusiast, or responsible for innovation in your company, looking for exclusive insights and content not found anywhere else, you won't want to miss our newsletter. Head over to www.bricks-bytes.com and sign up today to get cutting-edge material delivered straight to your inbox. Navitas Capital is one of the earliest investors to enter construction tech. And today we were lucky enough to be joined by one of their principals, Jenny Song. In this episode, we discuss what Navitas is looking for when investing in the built world. Jenny shares her intriguing insights into the future of AI in construction, including how it might reshape traditional business models and create new investment opportunities. And finally, we have a candid discussion about common pitfalls in construction tech investing and how even experienced VCs are adapting their strategies in response to the emerging trends like AI.
And now, an announcement from our sponsors. This episode is brought to you by Shft, helping contractors like you leverage BIM to secure a leading position in the race towards construction's digital future. Visit maketheshft.digital for more. This episode is brought to you by Build Vision, transforming construction supply chain by bringing contractors, manufacturers, and stakeholders onto a single software platform. Visit buildvision.io to find out more.
Jenny, Jenny from Navitas, thank you so much for joining us today. Could you tell us what drives you to invest in, and by the way, you can correct me if I'm wrong, I put built environment here, but I'm sure there are other areas that you guys look at.
Yeah, well, actually, first, pleasure to be here. Thanks for having me. We absolutely focus on the built environment. That's all we invest in. So when we were founded in 2009, our thesis was that there was a ton of digitization opportunity in the built environment. So that includes real estate and construction, as well as infrastructure and increasing the energy as well. For me personally, I actually didn't know too much about the segment or the industries until I started at Navitas. I was a generalist, prior to being an investor with Navitas. I had spent some time in ed tech. I was a founder myself of a nonprofit startup in ed tech, raised venture philanthropy money for that, tried to make a go of it for 2 years. And so I knew I wanted to do something related to innovation in an industry that was different from ed tech because I ran into a lot of challenges in that segment and I wanted to have impact. So I was agnostic when I came to Navitas in terms of, what sector I wanted to work in. And essentially, the more I learned about it, the more I was just fascinated by the reach, I would say, of the built environment in terms of people's lives. So, thinking about everything from housing to, the impact of the built environment on climate to, just what's around us every day, right? And so that was all just interesting to me personally. And then, I think diving into it further and really realizing how much opportunity there is for innovation and digitization in this space got me increasingly excited about the segment. And so I've been at Navitas now for 4 years, investing really solely in technology that's applied to these sectors.
So built environment, am I correct if I divide it into construction technology, property technology, and perhaps climate technology? Is there anything else? Or is
I
it
think
not
that's
correct?
largely right. There's a little bit around logistics and supply chain that we also touch, but less so on the sort of transit component and more on, warehousing and sort of manufacturing and things like that. But we won't go super deep into like hardcore industrial tech. So those are sort of the edges that we would define.
You have an interesting we call it CV here in Europe, not resume. So just to make the clarification, is there anything, because you were a management consulting firm, Baines, from before, and also a Stanford graduate. So any kind of things that you picked up and learned there that just helping you with your role today?
Yeah, definitely. I spent 6 years at Bain in a couple of different capacities, and I would say there's like two different areas that have been super helpful in the investor seat, but also in terms of thinking about startups and advising startups. So in terms of investing, I spent a lot of time at Bain in the private equity practice, and so in that practice, you're basically doing due diligence for private equity transactions. Very, very generalist in terms of, the types of transactions those were. So one week I would be working on something for like a roll-up of bus companies, and then the next week it might be toxic waste dumps. Literally, those are two different, diligences I worked on. And so what you learn through that is like how to get up to speed really quickly on an idea, assess it, test it from all angles, understand the company, the market, the dynamics, the rights to win of various groups, and then, quickly make an assessment. So I think from an investing skill set perspective, that was really invaluable for me.
Is there a cheat sheet or some way of how to achieve the best outcome in terms of analyzing different things and looking at different things almost simultaneously, or how do you do it? What's your cheat song?
You sound like Stephen Bartlett now, Mark.
I don't know if there's
Who is this guy?
sheet. I think it's actually all the same categories you look at when you're a venture investor. So, what is the market like? What do we know about its size, its growth, the dynamics? Are there any headwinds or tailwinds? What is the competitive situation? How is this company positioned? Do the customers love this product or not? And then what is it about this particular company in terms of its team or its capabilities or some other wedge that it has? And then you look at obviously the track record and performance. So it's a little bit of a checklist in some ways, and certain things are more important in certain situations than others, but you're kind of going through a similar thing, and you're learning about, a different industry maybe, but at the heart of it, those are the things that you're trying to understand.
Mm-hmm. So speaking of maybe headwinds or tailwinds, do you see any construction having any of those right now? And why would someone invest in construction tech really? Maybe from macro point of view, or is there anything interesting happening in macro at macro level?
Well, there are tailwinds and headwinds that, in any situation, right? And right now, everyone continues to talk about interest rates and how that is causing delays in terms of projects and developments in different sectors. But there's obviously also tailwinds. There's a ton of investment happening right now in terms of electrification and infrastructure with the IRA in the US at least, but also I'm sure globally. And then, there's also the boom in different segments like data centers, like, in industrials. There's a major reshoring right now of manufacturing, at least in the US. And so that's causing a major development in terms of industrial facilities. And then housing and home building, continue to, be hot markets because we still lack housing, certainly in the US, but also globally. And so despite the fact that interest rates are high, there's a lack of supply of existing housing, so people are still building. So there's always puts and takes, but we still see, construction as being like integral to the future and where things are heading. And so it continues to be a great place, I think, to invest. And I think lots of investors are recognizing that, generalists as well. This is a huge market. It's incredibly core to the future of the economy, to energy, to AI, to data centers. And so there will continue to be investment in the space.
Yeah, have you seen anything from like you mentioned that generalists and that kind of stuff? Has there been like a noticeable increase in the interest from these people over the last, let's say, maybe, I don't know, 1, 2, 3, 4, 5 years?
I think there has. I guess I haven't quantified that necessarily, but we certainly speak with generalists, all the time, especially because they are often sort of the growth capital for the companies that we invest in. I think a lot of times, specialists like us will be the right lead for a seed or Series A, but then at a Series B, C, et cetera, there's not a ton of like construction tech growth capital, so you do have to go after the generalists to continue to raise. And I think we continue to see interest. I mean, we're talking to those investors all the time. They're always, curious about what's happening. And I think the fact that if you look at the success stories, particularly in vertical SaaS, the fact that Procore and some others have been, some of the top performers in recent IPOs and things have made the, I think, construction tech sector like paramount in investors' minds.
Yeah, I was reading Patrick's Hellerman's letter, kind of update on the VC state in construction tech, and he said, I don't know how he quantified that, but he said that AECS tech now at 0.53% of total VC funding, and that is 2x growth since 2021.
Still tiny.
Still tiny.
Tiny.
Yeah.
Considering construction is what, 10% global GDP.
Yeah, there's a lot more to do, for sure.
Yes.
Let's do it. So, with that said, can you tell us a little bit about Navitas?
Sure. So Navitas was founded in 2009. We got started in LA, and we now currently have 2 offices, one in LA still and one here in Chicago where I am. We're still a small team, about 10 people, half of us LA, half of us Chicago. And we've been, specialist investors really focused on construction, real estate, and the built environment in general since 2009. We were very early investors in companies like Matterport, PlanGrid. We were part of the Procore story via an investment in Honest Buildings. And we've continued to kind of invest behind our overall thesis of digitization of these spaces. We have about 450 million AUM right now. We're on our 4th fund. So we've, continued to build our track record. About a third, I would say, of our investments have been what we would very much categorize as construction tech. And then the rest, potentially people would call that more prop tech, energy, et cetera. And then I guess I would say the main thing to know about us is that we are primarily backed by strategic LPs. So I think something like 80% of our LPs are corporate or, strategic in nature. Think large real estate asset owners and operators, builders, developers, construction materials companies. And we also have a mortgage and insurance kind of segment as well, because we also do some fintech. And so these are, partners that we work with closely to understand, innovation from a corporate perspective. We help our portfolio companies navigate them in case they can be good customers or channel partners or just generally good advisors to our portfolio. And then, we're always trying to create that ecosystem so that the industry is getting smarter on technology and the technology providers are getting smarter as well on what the industry actually needs, because so many of our portfolio companies actually come from founders outside of that industry.
So you said for $450 million under management. That does not include the exited capital, right? From the exited.
No, that's just fundraised. Yeah, exactly.
Oh, so this is fundraised in total.
Yeah, for us, out of like the 4 funds, total 450 million. Mm-hmm.
Got you. And so, if, in terms of LPs that you work with, so there's none of them are like general LPs, who are not involved in construction directly, or are there people
We
like
do
that?
have, yeah, we do have a few. We have a couple family offices. We have an endowment, but they're sort of a smaller percentage of our LP base today. I think that, even those often do have some tie to real estate or construction. There's sort of a reason they're interested in the segment, either because maybe family wealth came from real estate or construction or something like that.
Okay. Could you tell us, I was doing some research and actually I connected a few dots between your background and also perhaps how Navitas operates. And it was really that you take more of an advisory role as just solely an investor. And I also noticed that you are board observers, you personally as well. So yeah, could you tell us a little bit about the philosophy?
Yeah, so we're very much focused on value add when we invest. We don't want to be passive capital, and that's part of the reason I think founders want to work with us. So we, in general, don't make a lot of investments. We're very slow or measured, I guess, in terms of our investment pace. Historically, we've made maybe one investment a quarter, but each of our investments is very high conviction. It's usually we're on the board. I personally am a board observer for a number of companies, but one of our GPs tends to be the board director. And then, I think a lot of us on the team have consulting backgrounds and then are used to working with those portfolio companies pretty hands-on. And so that takes a bunch of forms. One of them is, helping them navigate our LPs, right? We just talked about that. These are large corporates. Oftentimes, they have massive, complex organizations, and if you're trying to sell to them, it's not an easy task. You have to understand who the decision makers are, which groups are the ones that are the best fit, and so we're helping them navigate through that while also advising our LPs on why this is valuable for the organization as a whole. But we also do many of the traditional things that, VCs want to help add value in. So we're helping with talent, do a lot of financial help as well in terms of helping them think through things like unit economics, their next fundraises, how are they going to, plan for the next year or beyond, to the next milestone. And so I think the fact that a lot of our team have management consulting backgrounds is very helpful.
Jen, you mentioned 3 investments a quarter or a year, sorry?
About 1 investment per quarter. So we've historically done between 3 and 5 investments a year.
Okay, that's not too much, right? Is it because of some macro kind of environment, or that's how you approach just investing?
That's how we've always done it. We've actually, even when VC was going gangbusters, like in 2021, I think we only did 4 or 5 investments that year too. We've always just been very measured because we know if we're going to spend a lot of time with each company that we invest in, we can't have a portfolio of dozens and dozens of companies. We have to have a concentrated portfolio where we feel like we can add value, really but accelerate the trajectory of these companies. You can't do that if you're doing scattershot, investments. And, VCs are different on this. A lot of VCs do take the approach that you're building a huge portfolio and that's the point. That's not our approach. We want to have a select few, partners that we work with, and we want big outcomes though from those companies.
So if I ask about how do you see valuations of startups right now in construction tech, would you be even is that interesting question for you in general as a VC, or is it Is it
It is
not
interesting.
something you would be looking at? Maybe you're looking at other aspects of the startup when making a decision on investing or not.
Oh, we definitely look at valuation. I would say we have been very valuation disciplined. I think that's actually part of the reason we didn't go crazy investing in 2021 was, valuations were through the roof. And we saw deals that we thought were interesting, but were hugely overvalued in our view. And so we decided not to make some of those investments. And I think for us, that's been a good thing. And I think now valuations have come back down. We're seeing more and more, rounds that are flat to previous rounds, despite a lot of growth in those companies. And I think a lot of founders have put themselves and their investors have put themselves often in a bad position because, they raised at valuations that then put them in sort of down round situations in the next round. And so we have had a couple of situations where, we are then coming in on the next round and are having to clean up cap tables or something like that because of what's happened previously. But we do care about valuation. We are underwriting to big exits. Like every one of our investments has to have the potential to be a fund returner. You can't do that with the check sizes that we write. If the valuations are crazy, we need a certain amount of ownership for that to happen. And I'll just say, our check size is usually between, I would say, like 3 and 7 million for first check. So, we want.
That's a lot.
Is it a lot?
Yeah, for early stages, I think.
Yeah, so we're doing usually late seed Series A. So these are rounds typically between 5 and 15 million.
Okay.
Yeah, but with that, we want at least 10% ownership. So the valuation has to reflect that.
So when I see you on the cap table somewhere, that means that you owe 10%, right?
Yes, with a few exceptions. So we do also have a frontier program where we're writing really small checks. And I'm not including any of those. And those are often not on our website. Like we are, those are just relationship building checks that we are not necessarily expecting like huge outcomes from. Those are for founders that we're really excited by that are maybe a little too early for, core investment. Those are themes that we're really excited by, where, we're still seeing how the market develops. They're effectively like scout checks. And those are, if you see us on the cap table in a really small way, those are some of the reasons.
Fair. If I can always follow up with, so you mentioned earlier that you don't invest in the deal seems to be overvalued, which is perfectly fair. Can you have an example of how do you measure if something is overvalued in construction tech?
It is a hard question. I mean, I think we're all using multiples, right? But it's very hard to do that when you are in a, early revenue situation. I think everyone has seen that public SaaS multiples are in the like 8 to 9x range right now. You have to kind of play that out over the next couple of rounds. You're not expecting, a seed or Series A company to trade at 8 or 9x right now because they're going to be growing much faster than the public companies. So like you're thinking maybe 20 to 30x. But if it's pre-revenue, like it has to be more about how do you forecast that revenue coming in the next year or the next year. Can you get to a story that actually is believable and makes sense and will put them in a good position to raise that next round at a reasonable multiple, et cetera. So there's a lot of like working backwards, I would say, in terms of what you think is believable, what do you think the next round will be at, and can you justify a larger multiple based on growth or some other characteristic that is unique to the company. So it's not like a perfect math problem and a little bit more of an art.
Magic.
Black magic. Jenny, just on the philosophy point, how do you guys typically work with founders? Like, what's the communication cadence? Like, do you meet monthly?
It actually is very bespoke to the founder. So we have some founders that I text like every day, like constant texts. This just happened.
Do you use WhatsApp or text?
We use text more. I feel like WhatsApp is like not as popular in the US.
Yeah, I heard this. Sorry,
Yeah,
not to
I heard
hijack
as
the
well.
conversation.
Yeah. Yeah, there's some founders we text constantly. There's other ones where it's a little more cadenced. You know, they want to check in every month or more than that. We certainly don't go more than a month usually without talking to our founders, and we definitely have, you know, the more formal board meetings every quarter. Some of our founders have much more comprehensive reporting that's like monthly, and we talk through like things in depth. And then others, you know, it's more ad hoc. Like they need things constantly in our, or we need things constantly, you know, in terms of just coordinating on various things. So it can be very fluid.
What does the perfect update look like?
What does the perfect update look like?
Yeah.
Selfie with spreadsheet.
What was that?
Selfie with a spreadsheet.
Selfie and a spreadsheet?
Yeah. Ignore that.
I think like, you know, highlights, lowlights, honesty in terms of those lowlights, some key metrics. Hopefully those key metrics are things that we've talked about before, and we're all agreeing that those are the key metrics that we're kind of tracking over time. And those can be like qualitative too, like OKRs around how much product development has happened or something like that. And then asks, like, what are the biggest things that you guys need right now, either from us or others in our network, just like being super clear about where people can help. So I think those would be the main things.
What's the
And then-
craziest thing someone's asked you for?
Hey listeners, I want to take a quick break to remind you about the Bricks and Bytes newsletter. If you're interested in learning about the technology shaping the future of construction, you won't want to miss the valuable insights we share each week. To get this exclusive content delivered straight to your inbox, head over to www.bricks-bytes.com and sign up today. Link is in the show notes. Back to the show.
I don't think I've gotten anything too crazy. Most of the time it's just like introductions, like talent. Yeah, I wish I had a funny
We need
story.
another few mil, please.
Free meal.
Jenny, in terms of geographies that you guys invest in, is it mainly US or not necessarily?
We're pretty focused on the US. We do have some companies outside the US, but they have to be at least, you know, focused on the US market. Maybe not their entire operations, but at least have some operations in the US. And that's partially just because of where we're based and where the vast majority of our network is. So if we're going to help drive, you know, commercial adoption and things like that, it's our ability to be like a useful partner on the cap table is much stronger in the US. We have one Israeli company and we have one Canadian company. I think that's it outside of the US. But yeah, again, they're very focused on US markets in addition to the ones that they have abroad.
That's interesting.
Okay, cool. And last one on this, maybe Navitas, is how, it's very broad, but how does one get investment from Navitas?
There's not one way. Some of our investments are long-term relationships. So I'll give you an example. Document Crunch. We invested in that Series A at the end of last year. It was announced earlier this year. That's a relationship we've had for years. Like we met them 2 or 3 years ago when they were much earlier, and we've been just tracking them and internally had various things that we were looking for in terms of their development before we were ready to invest. And so that is going to be the case sometimes. Like it's going to be too early for us. We're going to want to see things develop, and we're building a relationship with a founder over time. In other cases, we just announced today actually an investment in a company called Paces, which is a a software platform for developers. That was a super fast process. We got introduced through a co-investor. We met them, that week. We had a subsequent meeting. They came in person. We did like a super day kind of, and it was like super fast decision. In all of these cases, I would say warm introductions are helpful. We do get cold outreach all the time from companies, and it's just very hard to filter through in terms of quality. If there is a common connection on LinkedIn or anything like that, tends to be quite helpful, and someone who can vouch for you as a founder. In Pace's case, like Resolute was the co-investor, and I had known this investor for a very long time and think very highly of her assessment of people. And the first thing that she said was like, this is a top founder in our portfolio. And that's like the reason we, decided to dig in. So I think that's quite broad. And then, our process, again, can be quite varied. It can be very fast, and we kind of went through the list of things that we're looking at, right? Like market, your product, competition, all of those things we talked about before. We're going to want to understand. And sometimes companies are too early to really have concrete answers on those, and that's fine. We don't have like, okay, everything needs to be absolutely check the box. Sometimes it's too early to really know, but you have to have a story or, compelling reason why you think it's going to play out the way that you think it is.
Is there one single metric that you look the most at when you think about is this a good idea or startup or founder?
I don't think there's one thing. I think for us, especially now, we are very scrutinous of your tech talent. I think it's an arms race right now with AI. And everyone is saying like, oh, I'm going to be the AI for this, AI for that, right? And we absolutely are excited by vertical AI and investing in the app layer of AI for construction and for real estate. But for us to win in that space, it's going to be about talent and a number of other things, which we can go into as well. And so, if you're an AI company and, we don't see like real tech talent behind that and sort of ability to continue to recruit that tech talent, like that's not interesting to us right now. So that's probably like one of the biggest things we're focused on right now. And then if we're talking about more Series A and later as opposed to seed, I think we have gotten pretty focused on efficiency as well over time, which I think you'll hear from lots of VCs, especially after, the craziness of 2020 and 2021.
By efficiency, you mean profitability?
Not profitability strictly, but how much capital have you raised to get to where you are? Have you used your capital wisely? Are you going to use your capital wisely? And then, what are your unit economics looking like or going to look like over time? Even if your unit economics are not perfect now, is there a very clear path to those unit economics being more ideal in the future? Because it's harder and harder to raise more capital, so we can't rely on just a ton more funding to come in and spending your way out of some of those issues. I think especially at Navitas, like we've always been pretty concerned about unit economics and things, but I think that's just been in the industry like a lot more scrutinized over the last couple of years.
So as I touched on profitability, maybe you have some thoughts on like the startups need to be profitable at a certain stage, or some of them can be excused for not being profitable. Like, what's your general thoughts on profitability in startups in construction tech?
So I think different investors will have different views on this, and we honestly get into, I would say, debates with other VCs who are on the cap table with us about this. Our view is we are not in the business of driving to profitability in the near term. VC is meant for big outcomes, and the goal of our capital is to invest in growth. And so we are not looking for companies to be profitable at the early stages. At a C or a D or later, yes, you need to have a clear picture to profitability. You might not actually go on that path because you're continuing to invest in growth, but you need to have some believable story to get to profitability. At a seed A, even B, I think there's been an over focus on profitability. Again, that is slightly different though from unit economics, right? Like each variable sale of whatever you're doing should hopefully be profitable. Like you shouldn't be losing money with every incremental piece of growth that you're capturing. But from a company standpoint, we're not looking for profitability. I think that's the piece that I think people have lost a little bit. Like if you're expanding to a new market, of course you're not going to, be profitable, but hopefully your existing markets are showing that they will get to profitability, right? So that's kind of where, we're digging in, and I think at a more granular level on those, and we don't want to get confused and drive all of these companies to profitability when that means they're not going to be investing in growth and getting to the big outcome that we, saw and wanted to invest in.
Okay, cool. So, Jenny, what are the tech trends you guys are currently looking at within construction?
Well, obviously AI, which comes in a lot of different forms. We have been pretty interested in embodied AI as well. So that's kind of, the mash of generative AI and other types of AI with robotics and other types of machinery. If you look at construction, obviously so much of it is physical. So when we think about AI, we can't just be constrained to the desktop work. Like, how is AI going to actually impact the physical pieces of construction? So that's something we're pretty interested in, but haven't made a investment there yet. There's a lot of technology development that still needs to happen. There's the interplay of sensors and then the brain and the actual robotics. So those things are all being figured out, but that is something we're very excited about for the future. And then kind of more traditional, I guess, AI would be around things that we've invested in around reality capture or document management or construction drawing, looking at construction drawings. There's so many other pieces of really what is desktop work that we feel can be automated, and we can all roll our eyes at ChatGPT, and it makes silly mistakes when it comes to actually corporate use. But there are a lot of other companies that are either building on top of OpenAI and other models, or building their own models that are specific to construction that we think are going to be pretty impactful in the near term, or are already impactful.
Have you got any companies in your portfolio that you recently invested in, and they are?
Yeah, I was going to say, same question, sorry, Martin, about
That's
document crunch.
Yes.
Can we go there?
Yeah, we have a
Why
couple.
you guys invested? Martin, is that where you were going?
I was going to ask about companies that you invested in recently that their main theme is to innovate within construction based on AI engines.
Yeah.
That was my question.
Well, yeah, document crunch is definitely one of them. So for those who don't know document crunch, they are basically a legal and contract risk AI platform. So their first product, which is where they started, is looking at construction contracts and helping back office, sometimes legal teams, but sometimes project teams, really assess what's happening in that contract, where are the risks. It has workflow tools to help negotiate contracts, but also after the contract is signed, kind of flagging for the teams that actually need to execute that contract. Like, what are the things that they're going to be held to? And a lot of times, we know that these are really long documents. People are not really paying attention, even though they can result in millions or hundreds of millions of dollars of damages or liabilities or other things. So Document Crunch started with that, and then now is moving even further into the field, where what they're doing is trying to show you what the contract risks are as things happen in the field, as you're actually executing on the project. So let's say there's a delay on a construction site, and you're having to change the schedule in some way. It would then understand that that is what is happening based on what you're doing in a platform like Procore, and then show you, like, this is what you've agreed to in the contract in terms of sending notice or something else, and then help you actually execute that so you don't fall out of compliance. So that would be an example of using AI to understand text, and then hopefully in the future as well, like images and other things in a document, ensuring that those insights are not just available to someone who's reviewing it, but also to people who need to know about it, even if they're not reviewing it. And those are things that are not happening today, or if they are happening, are requiring expensive legal work and other things. So that's an example of, a concrete way that, we see AI as helping the industry.
Okay. Why did you guys invest in Document Crunch?
Why?
Yeah.
A few reasons. So we talked about how it was a long relationship. I think we were, compelled by this idea that AI could help the back office, but we didn't know how big that was going to be when they first started. We got more and more excited about Document Crunch the more that we saw them go into the field, because that's where we felt like the value was. I think it's not lost on us that the words like general contractor, subcontractor have the words contract in them, like the contract, and executing to the contract is the most important thing that they're doing. So we felt like, there just had to be a ton of value to be had in that notion of like ensuring that everyone actually knows what they're doing, and, reducing the risk that these companies are facing. And so we talked to customers, we talked to other, folks in the industry, and validated that that was true. The reason we got particularly then excited about the investment, not just thematically, but like because of what they were doing, was then they started to enter into these like very strategic partnerships with other platforms. So they announced at Procore last year that they had this deep partnership with Procore, and then there's a couple of other partnerships that are happening as we speak, which haven't been announced yet, but that we've been kind of engaged with. And so for us, it's not just that this technology has a lot of value.
By the way, there's one with Bricks and Bytes. We're recording an episode with them next week. Just saying.
Oh, nice.
Carry on.
Oh, she must know it that she's a board observer, so she must.
I don't know the movements of every one of our founders at all times, but like one of the biggest things for us, especially with AI, is like, how will you get distribution? Because it's one thing to just build an interesting AI tool, but it's another to be able to get that in front of people when they need it, where they need it, at the scale that you want it to be. And so for us, like the fact that Document Crunch could essentially lock up distribution through Procore and some of these other partnerships that they're working on, was huge. And so that like turned the page for us in terms of, wanting to invest versus just wanting to track them.
I wanted to touch on your role here as a board observer within Document Crunch. So what's the difference between board member and board observer in general? Maybe can you tell us a little bit about your role as a board observer within Document Crunch?
Yeah, sure. So I'm a board observer, but Travis Putnam, who's our founder and general partner, is the board member at Document Crunch. So together, we serve on the board together. Yeah, the main difference is that like board director has like voting rights and the board observer is just there to discuss and opine. So, the board director, depending on the makeup of the board, will have oversight over things like compensation for the CEO, hiring and firing of the executive team, approval of the budgets, things like that. And they also have liability. Like people can sue the board of directors if like the other shareholders could sue the board if they don't like what's happening. Or, someone could say like, this company is ruining my life. Like I'm going to sue the board. And, there's actual like individual liability. Whereas a board observer doesn't have that, but is just kind of there in the conversations. So that's kind of the main difference.
Yeah. Okay. I wanted to ask about defensibility of AI solutions generally, not specifically to any of the companies we discussed, but how obviously it's something you must assess before you invest. So what are you looking at, and what's your thoughts on that?
100%. Defensibility has been, I think, like the key question that everyone's asking with AI startups. I think the way we look at it is that in some ways it's not that different from asking about defensibility for any software startup. So defensibility can come from a number of different things. One of them could be distribution, which is what, we think document crunch's defensibility really comes from. But that distribution, like you have to scrutinize that. Is that just, a surface level distribution partnership that anyone else can also establish, or is it exclusive in some way? Why is it exclusive? What's in it for the distributors? Like, is there something actually there that is sticky and will make it hard for some other competitor to come and, establish the exact same distribution network? Another major piece is the actual data and models themselves. It's very different depending on where you're building. So there's some places where the data is very public and readily available, and so it's very hard to establish some sort of technical advantage there. There's other places where there's not a lot of data. It's very private and very difficult to structure the models on. So Firmus is another example of an AI startup that we're invested in. They're looking at construction drawings, and they have not been able to use off-the-shelf models to do what they do because it is so specific. Construction drawings are so specific to the industry that you can't just use some sort of generic computer vision model to assess them. They've had to build painstakingly their own models, train their own data, and that is a huge moat because it's not going to be replicable by others, and they've now captured so much data that others, would have a hard time doing without. They have a huge lead on that, right? The other piece is talent. We've talked about. There's lots of people who are innovating in AI right now, but there's actually still a limited set of people who have sort of the experience in AI, that have the legitimate training in AI, that are true technologists, that can best understand how to, leverage the right models, construct, the right architecture for their platform to make use of those, and then continue to, as I said, recruit more and more talent for these companies, because that is going to be the race. You're one of our other AI companies, which is not in construction tech, but more in property tech, Elise, their huge advantage is the talent that they have recruited. Like every one of those engineers on their development team is like a cut above, the startup, like the rest of the startups that we see. And they have an insanely high bar. And sometimes it makes it hard for them to hire quickly. But because of their ability to hire that amazing talent, their product development is insanely fast. They deploy new updates constantly have just been like absolutely on a tear, building products in the space in a way that, you know, we don't see very often. So talent, you know, for us is another big one. And then there's things like integrations and user experience and things like that, which they're not really defensible, but they're like part of the DNA and sometimes of the company, like real product focus on making sure that the user experience, the deployability of the software, and all of those things are best in class, because compared to, you know, a vertical SaaS company, like that is what you're going to have to win on. You can just put a little chat in the side of your platform and call that like AI, but is that actually how people want to interact with AI? Is that the best way to ensure that like what you're doing actually is adding value and replacing hours of work? And, you know, like are people actually going to be able to harness that? So the user experience piece and kind of building, whether it's integrations or other things around the AI is also super important for us.
Do you have any examples of companies within your portfolio that tackle construction drawing issues or design tech?
That's what Firmus does. So they're computer vision AI company that is assessing construction drawings and looking for errors. They sell to GCs and help GCs understand the bidability basically of those construction drawings. And, you know, because so much, especially in the US, I think it's a little different in Europe, so much of construction is still done kind of 2D. Like that is why it's particularly important. And these are like PDF drawings that don't have like metadata associated with them, right? So they're working from something that is very analog in a lot of ways, and then effectively constructing, you know, a schematic for what that is more in 3D, and then doing kind of analysis on top of that. So it's actually a very complex kind of design and computer vision solution, and that's where, you know, their moat comes from, is the technical piece, because there are a lot of other platforms that are able to take BIM models, right, and then assess those for errors or what have you, but that's because the work has already been done in some ways. Like a BIM model already has the data like tagged to it and associated with it, whereas, you know, for most of construction in the US, it's still, you know, 2D.
Mm-hmm. Yeah, Firmus, I think it's interesting as I think the reason for their existence is actually, we interviewed them a few weeks ago, is the fact that the software stack is so imperfect that you need to check if what's designed it's done correctly, and also there is a collaboration piece of it and human error. But yeah, I think it's interesting, very interesting concept what they do.
Well, I think that's the thing that's like kind of important to know, to understand about construction, right? So we can wish that there is like a more perfect construction software stack, and that systems will all talk to each other and there will be so much data, and like, but that's not the reality today. And with AI, you don't have to sort of wait for that reality to happen. Like, we think that all of these solutions are actually going to create these bridges, and like maybe that's not the most efficient solution in the long run, but that is the one that's more likely to be adopted, you know, in construction.
Yeah, absolutely, 100% agree with that. Jenny, there's two main things I wanted to touch upon as well, and some stuff that you mentioned when we first chatted like a few months ago. Do you remember this? Because I made a note and it says tech-enabled operators.
Yes.
What's your thoughts around that? I couldn't remember.
Well, actually, So I think when we first talked, you know, one of the, I think, pitfalls of investing, you know, in startups in construction is the fact that a lot of the startups in construction have historically made a decision about whether they're going to be technology companies or technology-enabled operators of some kind. So what I mean by that is you could be, a software company, or you could be a builder that is building its own software and actually executing on construction, right? And there has been a lot of investment in construction in those operators, and they did build technology or are building technology. But at the same time, the root of what they're doing is actually competing against industry incumbents in some way. So if you think about like Katera, or if you think about Vive, or some of these companies that were like building physical things, their economics in some ways mirrored more like a traditional builder than a technology company. And because of that, I think, investors can get into trouble because they were valuing these companies as tech companies and giving them the multiples that tech companies have and expecting them to scale and grow in the way that tech companies can. When, the structure of what they are building in terms of, how their resources are deployed, how do they scale, which has a geographic component to it and all these other things, is not aligned to that. And so, things could quickly go off the rails as a result of that, right? In our view, there was like a bit of a mismatch between the type of capital and the actual startups that people were investing in. I think my view on this has actually changed a little bit, even over the last couple of months, and it's because of AI. So I think it's not a blanket statement, but I do think increasingly with AI, there will be more tech-enabled operators now and tech-enabled services that are more like actual software companies, because those services and those operations will be more and more driven by an AI component. So that's not true in terms of building today. What we mentioned, like there's still such a physical component to building. But if you think about other services, so I'm going to take like accounting as an example. Like in the past, I think we would have said a tech-enabled accounting company should not be valued like a software company, and it would be hard for us to, make an investment in a tech-enabled accounting company pre-AI. Mm-hmm. Now, I think with AI, like we will see accounting companies that are basically AI software companies.
That's interesting.
Right? So I think that actually does become investable for VC and can scale in a different way. And it's going to be a different model. Like you're not going to be selling seats and licenses. You're going to be selling the outcomes and the work the same way that accounting firms do. It's not going to be you're not going to be able to bill hours because AI is, hopefully fast and doing it much faster. But you're going to be you're going to be charging for outcomes. And so I think that's a shift in how we're going to invest. I think that's, VCs are all going to have to figure out, what does that mean? How do we value that? But it's a huge thing that I think we're tracking. We have a company that we just invested in, I mentioned, that automates parts of development. And like we've talked with them quite a bit about how over time they're going to have to charge on outcomes and success fees and not like seats and licenses. It's a big shift.
Yeah, I love this, absolutely, this one.
Should we touch on one last topic? I think we should think about wrapping up in a few minutes.
Just a second on this subject. So, there was so much in it. I need to structure my thoughts.
It was a really great answer.
Exactly. So, so do you think that startups right now, when they try to sell to large incumbents or large contractors or companies, is it a long-term sustainable solution? Because as you said, these larger companies having capital, they probably could start developing, and they will be developing their own solutions internally, because every large incumbent have their own processes. So I think it's a wish if someone thinks that getting a general software dedicated to a solution, but it will work with every contractor, for example, and it will be adopted by every contractor. It's a kind of a wish. It's not something that will work probably well, especially if someone can now have a dedicated team who will write the software bespoke to a problem. So yeah, any thoughts on that?
Yeah. I think in construction, we over focus on the top contractors because those are the ones that can do what you said. They have adopted technology more so than the mid-market and SMBs. But they also, to your point, potentially can have the resources to have their AI assistant coder or AI assistant whatever build some of these things. So I think as a first set of logos and things like that, the ENR top 400 are 100% a great place to start. But in construction, you have to figure out what is your strategy for the middle market and the SMB segment. Like, there's only 400 contractors in the top ENR 400. So, and you're not going to get all of them, and some of them are going to do their own thing. So for us, that is why I actually go to market and what is your strategy for the long tail in construction is really important. And not me personally, because I wasn't at Navitas when we invested, but like PlanGrid is a great example of a company that captured the longer tail of the market and had a go-to-market strategy that was well suited to capturing, and they had thousands and thousands of customers when they were acquired by Autodesk, because like you can't build $1 billion business in construction just by going after the enterprise segment.
Beautiful.
Lovely. So, yeah, I feel like we were really getting into the flow of the conversation, but unfortunately, time doesn't permit. Maybe just a few.
Oh, it's too short.
I know. Always too short. One last thing. What would you say is one last question? And I would suppose pick on something not controversial, but just like where external investors who are not in construction technology go wrong.
They're not in technology or not in construction, sorry.
Not in construction technology specifically, and give like stale advice, or perhaps just don't understand the market. So mislead founders.
So where generalist investors go wrong when trying to invest in construction tech?
Well, even it could be specialist, but I'll leave it to your imagination,
Yeah.
Jenny.
Well, I think a few things. I mean, we've touched on some of it. Like, I think a lot of previous mistakes came from investing in models that had a operational component that was difficult to scale and that didn't really that weren't really dependent on technology and more dependent on like, can this business be an efficient operator? And then I think the second thing is actually what we also talked about in terms of understanding that this is such a fragmented market. Like, people look at it in construction and are like, it's $14 trillion in the US and however much it is globally. And it's huge, but it is so fragmented. There are so many components and segments. And so that doesn't mean that there can't be a solution that spans all of those. Like, that's what we want, is to find the solutions that are able to address like the whole market. But what is the strategy for that? And like, is this solution only well suited and only has a right to win in, a very small segment? Like, maybe it's a super sophisticated technology, but like only the ENR top 400 are ever going to deploy, because it just doesn't make sense for the middle market or beyond. So yeah, I think those would be the biggest things.
Great. The last one from me
Very
would
good.
be what. So you have 7 companies that you exited from within Navitas, and so what's the ideal exit? Is it IPO or is it some other exit? So that's one question about ideal, and what's most common?
Most common is definitely acquisition. So when we're making an investment, we always have to think about, there's going to be multiple routes to exit, and given that IPO isn't the most likely, although that's usually the most desired one, what are the other options? Like, who is going to acquire this company? Do those exist? And are big exits possible, even if it only quote unquote gets acquired? And I think the good thing about construction is that there have been a lot of big acquisitions with good exits. In some other industries, that might not be the case, but we've seen, Autodesk acquired PlanGrid for $900 million. Nemetschek just acquired a company for $700 million. Hilti has acquired Fieldwire for $200 million, right? So these are still like good exits typically, but you have to think about that. Like, what is the right fit in terms of that? We, usually are underwriting though to a scenario where like we want to be able to see an IPO. Like, can this be a standalone company that is worth $1 billion or more? Not every VC has that requirement, but for us, like with the size of our fund and the way that we construct our portfolio, we will not invest in a company unless we can see it really be that standalone company at $1 billion valuation. And that, we're not saying that is like obviously going to happen for every company, but there has to be at least like a story to tell and a path to get there.
Very good. Okay, Jenny, can you tell us and our listeners where they can find out more about you and Navitas?
Yeah, so navitascap.com is our URL. My email is jenny@navitascap.com. And you can follow us on LinkedIn. We're pretty active on there as well.
Okay. Thank you very much, Jenny.
Thank you, Jenny.
It's very insightful.
Thank you, guys. Love being here.